Okay, we're getting to some fun ones here. Some that take a few slides. And this is going to be annuities. Annuities are always so much fun. And if you don't know what an annuity is, it is an instrument that the taxpayer buys, usually at retirement. It's usually retirement benefits anyway, in return for periodic payments for the remainder of his or her life. So again, these are going to have payments that pretty much either come every month or every day. Now, the amount of these periodic payments are based on two things. One, the purchase price. Second, the life expectancy of the annuitant. It's a fun word. But basically of the person that has the annuity. So again, this is all scheduled, and this is basically predicted by whoever you bought the annuity from. Now they probably use standard mortality tables based on that annuitant current age and use to calculate that amount. Cool thing is, if you survive past the whole mortality year, basically you're free and clear. Basically earn more money, which is nice. But we have some fears, and we actually have some formulas into this. So we have what is known as the simplified method. So this simplified method is pretty cool. Individuals are generally required to use the simplified method to calculate this taxable amount from an annuity if the annuity payments commence after November 18th, 1996. So most brand new ones are using the simplified method. And what we use is we calculate the excluded amount from the IRS, providing a simplified method worksheet. They have to actually go look that one up, so you can see what the worksheet is. If they have it on their website, they should. Fun research! Research! So, you know what? Let's go ahead and see if we can find it. So, escape. Right here. Let's see. Here's our topic. Here's our simplified method. Definitions. Let's see. Publication 575. And you can see how this works. As you can see how I'm looking for this simplified method worksheet. Very quick. Alright, we need to go ahead and find there we go. And there we go. Worksheet A. See? Takes a little bit. So let's blow this up. So there we go. Oh, kind of lost it a little bit. See, it's either down or it's up. There we go. And there's worksheet A. Found it again. So this is the neat little thing I always love about taxes, is even though you're getting the understandment, you can actually find these worksheets on the IRS and actually basically read step by step. And it does go through step by step on any item. So this one actually tells you to enter the total pension or annuity payment received this year, and it even tells you where you can find it. Enter the cost of the plan of the annuity. Enter the appropriate number from table 1 below, which there's table 1, and table 2. Okay. Divide line 2 by number along line 3. Multiply line 4, so forth and so on. And basically subtract and add. And then you come down and was your annuity start date before 1987? Most likely it's going to be no, so we're going to add lines 6 and 8. And balance of cost to recover, so forth and so on. Now, they actually have a death benefit exclusion. Up to $5,000 applied to certain benefits replied by employees who died before August 21, 1996. Where is that star? Because that's interesting right there. There it is. But, so we're not going to end up dealing with that either. That's interesting that it's still there. But hey, we go with it. So again, step by step, there's our simplified method worksheet. Took a little bit, but we found it. Okay, back to the slides. Alright. So, we do have the general rule. Now, before implementation, did not say that word correctly, of the simplified method, we have general rule was used for most annuity calculations. Remember, this is going to be what's used before November 18, 1996, if any annuity payments commenced before then. And this could be a possibility still, because annuities can be around for quite some time. Now, it's getting closer and closer, more likely we won't be using the general method soon. Again, this has been getting close to 30 years. And we still have like 5 more years, so it's like 25. But yeah, so most annuities are now starting to quit out. Again, depending on when it was. But again, if it does end up qualifying for the general rule, taxpayers are not must calculate amount to exclude from income by using this equation. So amount excluded equals the investment in contract, so basically how much money do we put into the annuity, divided by annual payment, basically for the annuity, times life expectancy. So again, we have to use the more mortality charts, tables, and so forth, times amount received. Okay, a little bit easier formula. Again, most of this stuff for us is going to be provided. We don't see a lot of annuities anymore, but we would end up doing this form. Again, most likely you're going to be doing the simplified method. Okay, now employee annuities. Okay, now employers may make periodic payments to retirement plans on behalf of their employees. These are a little bit different than pensions, but we could have these annuities. Now, the payments are not taxable by any means to the employee in the current year if made to qualified retirement plans. Again, this is your 401k, your 403b, your Roth. We're going to get into a lot of retirement plans. Whew. But they are not considered part of an investment when calculating the exclusion ratio as well. So they're really talking about that general rule. So let's do an example, because we need an example. Annuities are crazy. So we have Din, and they have saved $750,000 in his retirement account and used it to purchase an annuity. Wow. Anyway, his annuity equals to $4,800 per month, and the standard mortality table shows he is expected to live for 19 years. How much of Din's retirement is excludable from tax each year? Assume that Din is required to use the general rule. So, because it has to be an example and use the formula, we have to use the general rule. Yeah. Or we could have done the simplified worksheet, but again, this is a PowerPoint. I just showed you how the simplified worksheet is. So, don't expect you may actually have it. In fact, kind of want to go through it with this too. But, how do we figure this out? Okay, formula, investment in contract. That happens to be $750,000. Annual payment is $4,800 since it's per month times 12 months times his mortality rate of 19 years. Okay, so this equals to 0.685. Or 68.5% of the amount is excluded from tax. Not bad. So from this, you basically have the percentage of multiplication of 4,800 divided by 12 months equals to 39,456 annual exclusion. I got a question there. Yeah, that's probably going to be right. Let's check our calculator, just to make Cengage sure. Okay, so we have 0.685 multiply 4,800 divided by 12. Yeah, that's a good question. It's probably going to be 4,800 times 12 times 0.685. Yeah, there you go. They messed up on the formula. That's supposed to be multiplication and not division. See, this is when you kind of know math. I mean, any tax account is supposed to know a little bit of math. And it just doesn't look right. That did not look right at 4,800 divided by 12 months. That's supposed to be multiply. Okay? So, if you have your friendly editor tool, which again will not let me edit, remember, this is supposed to be multiplication, not division. Alright. So let's go look at the simplified method. I'm just curious, will it come out to the same amount? Doesn't hurt, right? So, simplified method worksheet. Let's pop out the PowerPoint. Okay. Are we still with the right spot? No, of course, it changes. So, there we go. Okay, so we're going to enter the total pension of annuity payments received for the year. Now again, I can't actually edit this because I'm doing it right now. So, total pension of annuity payments received this year. One. Let me see here. Let's do this. File, new. blank document. Again, doing this all on the cuff. Okay, so 1. This will be the 4,800 times 12, which equals out, I'm going to expand, equals to 57,600. Alright, step 2. Enter the cost of the plan at the annuity start date plus any death. Okay, so the annual plan was $750,000. Double check. Alright. 3. Enter the appropriate number from table 1 below, but if your annuity starting date was after 97 and the payment are for your life and that of your beneficiary, enter the appropriate number from table 2. Let's just say table 1. And he's got 19 years. Okay, so really we don't have all the information that we need. This is married. So we're going to give this guy, say he's classic retirement, 66 to 70. Okay? And we're going to say it started after. Let's do it that way. So 66 through 70. So we're going to put 210. Because why not? We have to do an estimate on that because we weren't given his actual age. But we're going to assume that he's at proper retirement age. Okay? It said divide line 2 by the number on line 3. So 4. We're going to take 750,000 divided by 210. Which gives us 3,571, and we're just going to round it to whole dollars. Okay. $3,571. Okay. Next, line 5. Multiply line 4 by the number of months for which this year's payment was made. Okay. So 3,571 times 12. So about 42,852. Okay. Line 6. Enter the amount previously recovered tax-free in years after 1980. 0, 7. Subtract line 6 from line 2. So basically 750,000 minus 0 equals 750,000. Line 8, enter the smaller of line 5 or line 7. So here's line 7, here's line 5. Which of course, line 5 is going to be smaller. There we go. 9. Taxable amount for the year. Subtract line 8 from line 1. Enter the result, but not less than 0. Okay, so 57,600 minus 42,852 gives us a good amount of only 14,748. Yep. Okay. Using this simplified method, taking a lot more time than it feels like. All right. What's your annuity start date before? This is no. So no, add lines 6 and 8. Okay. So 0 plus 42,852 equals to 42,852. Whoops. Okay. So we already know taxable amount for the year. It's going to be 14,748 after an annuity of receiving 57,600, which again is not too bad. So balance of costs to be recovered. Subtract line 10 from line 2. Okay. So they're saying take 750,000 minus 42,852. So 707,148. And basically, again, the payments you receive next year will generally be fully taxable. Yeah. No. We will do the same thing over and over again. But this is the key that we have to watch out right here. So that is our taxable amount, considering what we just did with the simplified method. Again, I just assumed that he's 66 through 70. Could be different age. That's why we're not coming out to the same amount. But that's how we would have done the simplified method. Alright. So that's completely it for the annuities. So again, if you have questions on these, pretty much expect to pretty much do either one, the general method or the simplified method. Again, if you have any questions, please let me know.